Well, I think it has to be differentiated between what we see in the US and the UK. I think the US is in a much, much stronger position than the UK. You can see GDP growth in the UK is stagnating. We're starting to see the latent impact of interest rates kick in, as you expect. I mean, people don't remortgage immediately. It takes a while for this to kick in. And we've discussed this before. I think they've increased interest rates far too much, given the dynamics of the UK mortgage market. And you were talking earlier about consumer debt as well. I mean, credit card debt has gone up by 5+%. People can't pay off their balances, and this has a compounding effect. I mean, back to your point about, you know, is when you don't spend, is that saving? People are just being squeezed, and the cost of items is going up. Anybody who's been to Pret can see that. So consumption has to fall, and this is what we see always in a precursor to a slowdown.
Let me just go straight to the chase. What does that mean for what our viewers and your clients should be doing?
Well, I mean, it depends. It depends which sort of where you sit on the social hierarchy, I suppose. I mean, what we've seen. I mean, we're talking about Burberry earlier. I think the Burberry story is actually down to them trying to upscale. I think that's a stock-specific case. But what we've seen through this cost of living crisis is it's hitting people on medium to lower incomes disproportionately larger than people on higher incomes who typically have savings to offset that increase in cost of living.
Is there a silver lining here? We've been spending a little bit of the week talking about pensions as well. And what you've seen, the BT story, I thought was stunning. We've been talking about how bad the deficit is for so long. And finally, they've had some improvement thanks to higher interest rates. When we spoke to some of the big pension providers this week, they were saying, look, the market's very split, though. When it comes to the retail customer, they're just not signing up for fresh pension schemes, but the workplace is. So again, it feels like a very bifurcated market where the haves and haves not seeing the interest rate cycle work for them versus those that are not.
Yeah, I think that's right. I mean, look, the pension funds moving to a surplus from a deficit is entirely a result of rising interest rates. It's a technical factor that means they've moved to a surplus. I think what's going to be quite interesting next week is obviously we've got the budget announcement, so do we get some sort of stimulus package for pension funds to maybe invest more in the UK market? That could be plausible. But I mean, we can see the evidence is clear. Unless you provide an incentive for people to save in pensions, they're not going to do it. And it has to be through compulsion. But generally, cost of living's gone up, people have less disposable income, and they just don't have the excess savings to be able to put away in pension schemes. And
do governments like the UK government need to do much more on pensions at this point because the backdrop is so favourable? I mean, you know, what would the prescription be at this point? Yeah,
I mean, definitely. I think that's right. I mean, it's a sort of ticking time bomb, isn't it? Are you going to support people through the state and the national pension, or are you going to encourage people to save for themselves? I mean, the UK has proven historically it's pretty bad at that compared to places like Australia or the US.